From subprime to passive, how automated investing replicates the flaws of 2008. Summary statement. Modern financial systems use residential real estate to convert household labor into institutional credit, with banks extracting profits by packaging mortgage streams into securities and offloading risk. This structural flaw, characterized by automated, blind allocation, has mutated into a passive indexing bubble that mirrors the systemic risks of the 2008 financial crisis. Section 1, Introduction. The pattern behind two financial eras. The 2008 global financial crisis is often remembered as a housing crash. That description is accurate but incomplete. Houses did not bring down the financial system. Rather, the financial system transformed millions of individual mortgages into globally traded financial products, tying the balance sheets of banks, pension funds, insurance companies, and institutional investors to the uninterrupted flow of household mortgage payments. Residential real estate became far more than shelter. It evolved into financial infrastructure. The true product was not the house itself. It was the predictable stream of mortgage payments generated over decades by millions of households. Those future cash flows could be bundled together, securitized, rated, sold, leveraged, and redistributed throughout global capital markets. In effect, decades of household labor were transformed into institutional credit. When that stream of payments became impaired in 2008, the consequences extended far beyond homeowners. Financial institutions around the world discovered that they were all exposed to the same underlying mechanism. What appeared to be geographically diversified portfolios were, in reality, different claims on the same source of household cash flow. Once confidence in that system failed, the resulting contraction spread rapidly through the global financial system. Although extensive reforms followed the crisis, the fundamental architecture of automated capital allocation did not disappear. Instead, it evolved. Today, a different mechanism channels institutional capital into financial markets. Rather than packaging mortgage pools into structured securities, vast sums of retirement savings now flow automatically into capitalization-weighted index funds and exchange-traded funds. Investment decisions that once depended heavily on structured credit models are increasingly governed by predetermined allocation rules. Capital is deployed according to index construction rather than continuous security-by-security analysis. The instruments have changed. The underlying pattern has not. This paper argues that the central structural weakness exposed in 2008 was not simply excessive leverage or poor underwriting. It was the increasing replacement of independent judgment with automated allocation mechanisms operating at institutional scale. Before 2008, this manifested through structured mortgage products carrying investment-grade ratings. Today, it increasingly appears through passive investment vehicles that systematically allocate capital according to market capitalization. The comparison is not intended to suggest that passive investing and subprime mortgages are identical. They clearly are not. Their underlying assets, risk characteristics, regulatory frameworks, and economic purposes differ substantially. Rather, the comparison concerns the architecture of capital allocation itself. In both cases, institutional investors increasingly rely upon standardized rules, external frameworks, or automated processes that reduce the role of discretionary judgment in determining where capital ultimately flows. Viewed through this lens, the story is not merely one of financial innovation. It is a study in how modern financial systems continually seek to transform predictable cash flows into scalable financial products while distributing both capital and risk across increasingly complex institutional networks. Section 2, Residential Real Estate as Financial Infrastructure. For most households, purchasing a home represents the largest financial commitment of their lives. Traditionally, housing has been viewed primarily as shelter, a store of wealth, or a long-term investment. Within modern financial systems, however, residential real estate performs a much broader function. It serves as the foundation upon which large portions of the credit system are constructed. A useful way to understand this process is to think of a house as a financial battery. Each monthly mortgage payment transfers current income into accumulated home equity. Over time, households convert liquid earnings into a relatively illiquid asset secured by the property itself. While that equity gradually builds, The homeowner simultaneously generates a predictable stream of mortgage payments that extends over decades. Viewed individually, a single household contributes only a modest flow of capital. Viewed collectively, however, millions of households making regular mortgage payments create one of the largest and most stable streams of cash flow in the economy. That distinction is crucial. The financial significance of residential real estate does not arise solely from the value of individual homes. It arises from the aggregation of millions of long-duration payment streams that can be measured, financed, valued, and ultimately traded. Housing therefore functions as more than a collection of physical assets. It becomes nationwide cash flow infrastructure. This infrastructure also performs an important macroeconomic role. Rising property values often support consumer confidence, encourage borrowing, and provide collateral for additional lending. Homeowners may refinance existing mortgages or access accumulated equity through home equity lines of credit, allowing liquidity to flow back into the broader economy during periods of economic stress. Conversely, falling property values weaken collateral, reduce household wealth, constrain borrowing capacity, and impair the financial assets ultimately backed by those mortgage payments. The same mechanism that stabilizes the economy during periods of expansion can therefore amplify financial stress during periods of contraction. Residential real estate functions simultaneously as both shock absorber and shock transmitter. Recognizing this dual role is essential to understanding why housing occupies such a central position within modern debt-based financial systems. Section 3. The mortgage monetization pipeline. The transformation of residential housing into financial infrastructure depends upon an industrial process that converts household mortgage payments into tradable financial assets. The process begins with credit creation. Commercial banks originate mortgages by extending long-term credit to households purchasing residential property. In return, borrowers commit to making regular principal and interest payments over periods that commonly extend 20 to 30 years. Those future payments immediately acquire economic value. For the originating bank, a mortgage is not simply a loan. It is a long-duration financial asset capable of generating multiple sources of revenue throughout its life cycle. Initially, banks earn origination and closing fees associated with establishing the loan. While mortgages remain on their balance sheets, they generate recurring income through the net interest margin, NIM, the difference between the bank's funding costs and the interest received from borrowers. Holding mortgages indefinitely, however, ties up regulatory capital and limits a bank's ability to originate additional loans. Modern banking therefore emphasizes capital velocity rather than simply maximizing long-term interest income from individual mortgages. Securitization provides the solution. Thousands of individual mortgages are pooled together and transformed into mortgage-backed securities, MBS, allowing future household payment streams to be sold to institutional investors. This process returns capital to originating banks, enabling them to repeat the lending cycle while transferring much of the long-term credit exposure to new investors. Importantly, the mortgage itself is not a single economic product. It is a bundle of distinct financial rights that can be separated, valued, and monetized independently. Origination fees, funding spreads, servicing rights, securitization gains, and capital relief each represent different sources of economic value generated from the same underlying mortgage. Even after selling the mortgage, banks frequently retain mortgage servicing rights, MSRs, continuing to administer payment collection and loan servicing on behalf of investors in exchange for ongoing servicing fees. The result is an industrialized financial pipeline. Household labor generates mortgage payments. Mortgage payments become financial assets. Financial assets become institutional investments. Capital is recycled back into new lending. The process repeats continuously, expanding the availability of credit while deepening the integration between household balance sheets and global capital markets. By itself, this architecture is neither inherently stable nor inherently unstable. Its resilience ultimately depends upon the quality of the underlying loans, the assumptions used to value them, and the judgment exercised by the institutions responsible for allocating capital throughout the system. Section 4. From household labor to global capital markets. The transformation of household mortgage payments into global financial assets does not end with securitization. It continues through a distribution network that connects ordinary homeowners with pension funds, insurance companies, sovereign wealth funds, mutual funds, and institutional investors across the world. This is the point at which local household finance becomes global capital. Every mortgage payment begins as compensation for productive labor. A household earns wages, services a mortgage, and gradually builds equity in its home. At the same time, those monthly payments create predictable cash flows that can be pooled together with thousands of others and sold as investment products. The remarkable feature of this system is its ability to aggregate millions of small financial commitments into institutional scale assets. A single household mortgage carries little significance on its own. A pool containing tens of thousands of mortgages becomes a financial instrument capable of attracting global investment capital. The transformation can be viewed as a financial supply chain. Household labor generates income. Income services mortgage debt. Mortgage payments become cash flow streams. Cash flow streams become mortgage pools. Mortgage pools become tradable securities. Those securities ultimately become retirement assets held by institutions responsible for safeguarding the long-term savings of millions of people. In this sense, residential real estate acts as the interface between the productive economy and the financial economy. The homeowner sees a monthly mortgage payment. The pension fund sees a long-duration income-producing asset. Both are participating in the same financial system, but from opposite ends of the pipeline. This separation explains why the effects of housing crises extend far beyond domestic property markets. When mortgage cash flows deteriorate, the consequences are transmitted through the institutional investors that purchase claims on those future payments. Local housing stress therefore becomes international financial stress. The 2008 crisis demonstrated this relationship with extraordinary clarity. Mortgage defaults originating within one segment of the United States housing market ultimately impaired balance sheets throughout Europe, Asia, Australia, and elsewhere because institutions around the world had purchased securities derived from those same underlying payment streams. The financial system had successfully diversified ownership. It had not diversified the underlying source of cash flow. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. Why the 2008 system failed. The collapse of 2008 is frequently attributed to subprime lending. While poor underwriting undoubtedly played a central role, subprime mortgages alone were insufficient to trigger a global financial crisis. The broader failure resulted from a combination of leverage, securitization, flawed risk assessment, and institutional incentives that reinforced one another throughout the financial system. One of the most important vulnerabilities emerged during the period between mortgage origination and final distribution. Investment banks routinely purchased large quantities of mortgages from commercial banks, temporarily holding them while assembling mortgage-backed securities and more complex structured products. During this warehousing period, institutions financed enormous inventories of mortgage assets using short-term borrowing. Time became a source of risk. If mortgage values remained stable, the assets could be packaged, rated, sold, and removed from the balance sheet. If housing prices weakened before that process was completed, the institution remained exposed. Because many firms operated with exceptionally high leverage, relatively modest declines in asset values could erase large portions of shareholder capital. The issue was not simply the quality of individual mortgages. It was the combination of leverage and timing acting upon large inventories of correlated assets. Warehouse risk became solvency risk. The problem was further compounded by structured finance. Mortgage pools were divided into tranches with differing payment priorities and assigned varying levels of perceived risk. Senior tranches often received the highest possible credit ratings, despite being ultimately dependent upon the same underlying mortgage payments supporting the rest of the structure. This system relied heavily upon quantitative models that assumed national declines in housing prices would remain rare and largely uncorrelated. Those assumptions proved catastrophically wrong. As defaults increased, securities that had been regarded as exceptionally safe experienced losses far exceeding model expectations. The failure was not confined to mathematics. Institutional incentives also contributed significantly. Credit rating agencies operated under an issuer pays model in which the creators of structured products paid for the ratings required to market them. Pension funds and institutional investors frequently relied upon those ratings to satisfy investment mandates, reducing the need for independent credit analysis. Responsibility became increasingly fragmented. Investment banks designed the products, rating agencies certified them, institutional investors purchased them. Each participant operated within established rules and procedures. Collectively, however, the system accumulated far greater risk than any single participant appeared to recognize. The crisis was therefore not simply the failure of individual institutions. It was the failure of an interconnected decision-making architecture. Section 6. Blind allocation as the common structural flaw. The collapse of structured mortgage finance revealed a weakness extending beyond housing markets themselves. It exposed what may be described as blind allocation. Blind allocation does not imply that participants are irrational or negligent. Rather, it describes situations in which capital is deployed according to standardized frameworks that increasingly substitute institutional process for continuous independent judgment. Before 2008, this process appeared in several forms. Institutional investors relied heavily upon external credit ratings when evaluating structured products. Portfolio managers purchased securities that satisfied regulatory requirements and investment mandates. Risk models embedded historical assumptions directly into investment decisions. As long as each participant followed the accepted framework, the overall system appeared stable. Responsibility became diffuse. When questioned, each participant could point toward the preceding stage in the chain. The investment bank relied upon quantitative structuring. The rating agency relied upon statistical models. The pension fund relied upon published credit ratings. Each individual decision could be defended. The collective outcome proved disastrous. This diffusion of responsibility represents one of the defining characteristics of complex financial systems. The problem is rarely that no one follows the rules. The problem is that everyone follows the same rules simultaneously. When independent judgment becomes increasingly replaced by standardized processes, the financial system may continue allocating capital efficiently under normal conditions while quietly accumulating correlated risks beneath the surface. Only periods of stress reveal the extent to which those assumptions have become embedded throughout the system. Viewed from this perspective, the central lesson of 2008 extends beyond mortgage finance. It concerns the dangers of institutional ecosystems in which automated or rules-based allocation mechanisms gradually replace continuous critical evaluation. The financial instruments may change over time. The architecture of decision-making can remain remarkably similar. Section 7. The mutation, from subprime to passive. The financial crisis of 2008 prompted sweeping regulatory reforms. Banks increased capital buffers, underwriting standards tightened, and structured finance became subject to greater scrutiny. Many of the specific excesses associated with the subprime mortgage market were addressed. Yet the broader architecture of capital allocation evolved rather than disappeared. Over the past 2 decades, passive investing has become one of the dominant forces within global financial markets. Rather than relying upon active security selection, passive funds allocate capital according to predefined index methodologies. The largest capitalization-weighted companies receive the largest share of every new investment dollar. This approach offers genuine advantages: low costs, broad diversification, tax efficiency, and consistent benchmark performance have made passive investing an attractive solution for millions of investors. For many households, passive index funds represent an appropriate long-term investment strategy. The purpose of this discussion is therefore not to argue that passive investing is inherently flawed or destined to fail. Rather, it is to examine whether its structural characteristics resemble certain institutional behaviors that became problematic before 2008. In capitalization-weighted indices, new capital is generally allocated according to existing market size rather than an independent assessment of value. As companies appreciate and their market capitalizations increase, they automatically occupy a larger proportion of the index. Future inflows therefore direct proportionally more capital toward those same companies. This creates a self-reinforcing mechanism. Rising market value leads to larger index weightings. Larger weightings attract larger passive inflows. Those inflows can contribute to further increases in market capitalization. The process repeats continuously as additional savings enter passive investment vehicles. Unlike the mortgage securitization process, this mechanism does not involve deteriorating credit quality or complex structured products. The underlying assets are fundamentally different. The structural observation is more limited. In both systems, substantial volumes of institutional capital increasingly flow according to predetermined frameworks that reduce the role of continuous discretionary judgment at the point of allocation. That similarity deserves careful examination. Section 8, the institutional parallel. The comparison between the pre-2008 mortgage market and today's passive investment ecosystem is not one of identical assets or identical risks. It is a comparison of institutional behavior. Before 2008, enormous quantities of capital flowed into structured mortgage products carrying investment-grade ratings. Today, enormous quantities of retirement savings flow automatically into capitalization-weighted indices. The mechanisms differ. The pattern of allocation invites comparison. The parallel can be summarized simply. 2008 mortgage pools. Institutional investors blindly bought mortgage-backed securities because they trusted the system. Today, 2026, institutional investors blindly buy passive index funds because they trust the index. The phrase blind institutional buying should not be interpreted literally. Institutional investors are neither uninformed nor irrational. Rather, it refers to capital allocation that increasingly follows standardized rules, benchmark methodologies, or externally defined frameworks, rather than repeated security-by-security evaluation each time new capital enters the system. This distinction is important. Passive investing still exists within markets where active participants perform price discovery. Analysts, institutional investors, corporate insiders, hedge funds, and other market participants continue evaluating individual businesses. The concern is therefore not the disappearance of judgment. It is the gradual shift in the balance between judgment-based allocation and rules-based allocation as passive ownership continues expanding. History demonstrates that financial systems often function smoothly for extended periods, while positive feedback mechanisms reinforce prevailing trends. Only periods of market stress fully reveal how concentrated those flows have become. Whether passive investing ultimately produces similar systemic vulnerabilities remains an open question. It is not a conclusion. It is a hypothesis worthy of continued observation. Section 9. Where money flows and responsibility fades. One of the most enduring lessons of the financial crisis concerns responsibility. Complex financial systems distribute decision-making across numerous independent institutions. Commercial banks originate loans. Investment banks structure securities. Credit rating agencies evaluate risk. Pension funds purchase investments. Asset managers construct portfolios. Index providers define methodologies. Each participant performs a specific function within the broader system. Each can legitimately claim compliance with accepted standards, regulatory requirements, and fiduciary obligations. Yet responsibility often becomes increasingly difficult to identify when outcomes deteriorate. This phenomenon extends beyond mortgage finance. It appears whenever institutional processes become substitutes for independent judgment. Prior to 2008, portfolio managers could reasonably state that structured products carried investment-grade ratings assigned by recognized rating agencies. Today, many institutional investors can reasonably state that portfolios simply followed widely accepted benchmark indices. In both cases, the process itself becomes the primary defense. One sentence captures this institutional logic particularly well. We followed the index. It wasn't our fault. The statement is not intended as an accusation. It is an observation about governance. Modern financial systems increasingly evaluate professional conduct according to adherence to established processes rather than the eventual outcomes those processes produce. That distinction has profound implications. As financial systems become increasingly automated, accountability may gradually migrate away from individual judgment and toward institutional methodology. Whether that strengthens resilience or weakens it remains one of the defining questions facing modern capital markets. Conclusion: the conveyor belt never stopped. The events of 2008 are frequently described as a once-in-a-generation financial accident. A closer examination suggests a more nuanced interpretation. The crisis exposed vulnerabilities embedded within the architecture of institutional capital allocation. Residential real estate had evolved beyond shelter into the financial infrastructure supporting one of the largest credit systems ever constructed. Household mortgage payments became standardized cash flows capable of being packaged, securitized, leveraged, and distributed throughout global capital markets. The remarkable innovation of modern finance was not merely the creation of new financial products. It was the ability to transform decades of ordinary household labor into globally tradable financial assets. That achievement expanded credit, increased liquidity, and connected local economies with international capital. It also created new forms of interconnectedness. The subsequent evolution toward passive investing represents a different chapter within the same broader story. Mortgage-backed securities and capitalization-weighted index funds are fundamentally different financial instruments serving different economic purposes. Nevertheless, both illustrate how institutional capital increasingly flows through standardized allocation mechanisms operating at extraordinary scale. The comparison advanced in this paper is therefore architectural rather than predictive. It does not argue that passive investing will inevitably produce another crisis comparable to 2008, nor does it suggest that passive investing lacks substantial benefits for long-term investors. Instead, it asks a narrower and arguably more important question. What happens when increasingly large proportions of global capital are allocated according to rules rather than judgment? Financial history repeatedly demonstrates that systems optimized for efficiency often develop hidden concentrations of risk that become visible only under stress. Whether today's passive investment ecosystem ultimately proves more resilient than the structured credit system that preceded it remains to be seen. The underlying lesson, however, remains remarkably consistent. Financial crises rarely emerge because institutions intentionally ignore risk. They emerge because large numbers of rational participants simultaneously place confidence in the same frameworks, the same assumptions, and the same allocation mechanisms. The conveyor belt never truly stopped. It simply began carrying different products.